Investing directly in an unlisted business is an established way for wealthy or sophisticated investors to tap into the potentially lucrative smaller company market. When investing in unlisted firms, you can choose to invest directly in a single company or in a portfolio managed by a professional manager. Investing in a managed portfolio spreads your risk by providing diversification and gives you the comfort that each investment has had due diligence carried out by experts with a set investment criteria. The downside is that you place all the responsibility of selecting the right investments with the fund manager and have no say or perhaps visibility over where your money is invested. Investing directly into single companies allows you to take charge and gain flexibility and control. You choose which companies to invest in, how much to invest, and you can build your own bespoke portfolio based on your sector preferences, investment aims, and risk profile. That said, it can be high risk, and it's always important to diversify and only invest what you can afford to lose. Building your own portfolio will require more of your time. So what are the golden rules to remember when investing in single companies? There are a number of points to consider. These include deal flow and time. You need access to good quality investment opportunities. It may take time to find an investment you like that suits your investment objectives. Remember too, it's higher risk if all your eggs are in one basket. Another consideration is the strength of the management. It is vital that the management team of the company is experienced and has the skills to deliver the business plan. It needs to be a cohesive team whose interests are firmly aligned with shareholders. A proven track record is important. Consider if the business plan is robust enough. The plan and the assumptions underpinning the financial forecasts must stand up to scrutiny. Remember, the investment should work without tax relief. If you evaluate the opportunity on this basis, then you automatically add in a degree of prudence. Things rarely go entirely to plan, so do some sensitivity analysis to quantify the key risks. For example, if sales growth in year one is only 75% of what has been projected, what does this do to available cash in the business? The risk-reward profile. Do the target returns take into account the level of risk? You need to be comfortable with the pre-money valuation, otherwise making returns on exit will be that much harder. Exit. You will only crystallise value on exit, so you need a clear exit route. Who is likely to buy this business and for how much? Governing documents. When you directly invest in single companies, you become a shareholder. It's unlikely you will be actively involved in the day-to-day running of the business. Key documents to understand are the shareholders' agreement and the articles of association, which define directors' responsibilities, set out the kind of business to be undertaken, and the means by which shareholders can exert control and protect their investment. So, how can Wealth Club help? This may seem a lot to take in. We are here to help. You can gain access to our deal flow and expertise. At Wealth Club, we have access to single company deals from qualified sources such as corporate finance firms, accountants, banks, lawyers, and directly from companies. Many of these deals are not available through mainstream channels. We aim to find good quality companies that either have asset backing or high growth prospects across a range of sectors, so our investors can build their own diversified portfolio. Typically, our deals will have a lead investor that brings added value to the proposition. We don't give advice, but what we do provide is all the information a wealthy or sophisticated investor might need to make their own informed decisions. Before we promote a deal, we review the business plan and talk to the management team. We carry out our own research into the market and peer group companies. We scrutinise the valuation, the structure and target returns, and challenge these if need be. We set out what we consider to be the biggest risks. We provide you with our research report to help you make an informed decision to invest in a single company or not. The ultimate decision to invest is down to you. So, how does this work in practice? We receive numerous investment opportunities every month. We review the investment proposition and company information. Each deal we look at will go through a rigorous internal assessment. We only promote deals we consider have genuine investment merit. Indeed, the house rule is we only promote the deals we would invest in ourselves, we often do, or be happy for our friends and family to invest in. Once we select the deal to promote, you will be sent the investment information and our research report. You may need to sign a non-disclosure agreement first, depending on the commercial sensitivity. The Wealth Club team is available to answer questions, provide additional information if required, and arrange calls with the management team of the company. We manage the eligibility and application process, ensure the lawyers provide the relevant paperwork, and shares are allotted in a timely manner. Our fees are typically paid by the investee company, so there is usually no direct cost to investors. Once the investment is up and running, we receive trade-in updates and circulate to investors to keep them abreast of developments. If this is of interest to you, please contact the team at Wealth Club. Please remember, investing in single companies is not for everyone. As a prospective investor, you must be able to demonstrate that you are in a position to make your own investment decisions, that you are fully aware of the risks involved in investment in private companies and property, including the risk to some or all of your capital.